Hi friends, we are going to discuss now the working capital policy. What is this working capital policy? Is nothing but financing of the working capital. How to fund the working capital requirement. We have seen in the previous session two types of estimations. One is full cost basis, the other one is the cash cost basis. So we need some money for working capital. That is, as we said, is applications. Then funds are there. How are we going to link these funds to investment? The rule of financing or funding, friends, you will never invest short-term borrowings on long-term obligations. That will be a disaster. We have seen so many companies collapsing. Many real estate companies, in fact, they were taking money on fixed deposits, promising everybody will give you 24, 35, 36 and 40% interest. So many people invested in that. We are aware that teak wood plantation that came, and another thing, they were investing in real estate business. So real estate investing in land is a long-term application. It's a block of funds. Whereas the funds taken is short-term. That means whenever somebody asks you to pay back, you have to pay. Another problem is when you are investing in real estate, there is no cash flow. Monthly you don't get any cash flow. Only when you sell that, making a project, either plots you sell or construct buildings, sell it. So therefore the concept itself was totally wrong, and you find so many companies collapsed, people ran away, and investors gone to dogs. Therefore, very simple basics finance, never invest short-term funds on long-term applications. So I repeat, the rule of finance is never invest short-term funds in long-term applications. In other words, always use long-term funds for long-term applications. There can be no two opinions on that. Then your question arises, can we invest short-term funds in short-term applications? Maybe. Suppose short-term applications are 100 crores. Short-term means day-to-day you are investing in stock. That is a short-term investment because you hope to sell that stock and you get cash that will be used to pay the creditors. So current assets can be financed through current liabilities, little. But even there, you should not go entire short-term funds for short-term applications. Even in short-term applications, significant amount should be through the long-term borrowings. Because finance management is only risk management. First you should be able to manage the risk, then only return comes. But then, not every individual reacts to the same situation in the same manner. So therefore, there are some people who are very aggressive in business. We all know that if you invest in film business, the rule is very few people out of 1 in 1 lakh only could have stayed. Because today you may have success, 5 films are successful, 6th film may be bombing and all the money earned is lost. So similarly horse races, gambling activities and high risk businesses they are called. You may get high return, high fluctuating returns. The cash inflows are fluctuating, you cannot predict them. But then we have people doing that business. It's not that people are not doing the business. They have passion for film business, high risk businesses. So when you are trying to see risk management, risk appetite is individuals' thinking. Individuals, some people take aggressively decisions. They grow, they may become very great. But some people may not like to take, they are very conservative in nature. Some people are via media. So we are only trying to tell, if you are like this is the consequences. Suppose if a person is very angry person, And that angry man will always get into troubles. There are no two opinions. But when is the question? Sometimes people may like him, but after some time he will get into disaster. But then anger also may be important. For some time somebody is hitting you, you may have to retaliate. If they think that you cannot retaliate, they will attack you. So it's all question of how much you will play. That's going to be the business strategies. So we are now going to give you, explain you what are the possible policies. First of all, what is working capital policy? Financing working capital is called as working capital policy. 2. What do you mean by financing? Financing means, as we already discussed, procurement of funds, effective utilization. Now in this case, procurement of funds, funds are of two types, three types actually. Short-term funds. Short-term funds are those funds which are less than 1 year. That is, you have to repay them within a year's time. They are called short-term. Long-term funds are those funds which are kept in the business for more than 1 year. 1 to 3 years is called medium term. Above 3 years is called long term. So for our discussion, we are only taking short term and long term. So funds we have classified according to their period of holding, repayment, into short term funds and long term funds. Agreed. Then this side of working capital is, working capital as defined is the amount of funds to run the day-to-day operations. Suppose you take a business, a small business with a turnover of 10 lakhs. You may require 1 lakh rupees working capital, let us say. Over a period of time you are expanding. You are expanding your business lines, products and things like that. So naturally working capital required also will be increasing. But always friends, there are working capital will be of two components. Suppose total working capital estimated is 100 crores. In that there will be one portion which is called as permanent working capital. This is also known as core current assets. Permanent working capital is, in other words, when they give you a list of amount of working capital monthly for the year, the least amount is called permanent working capital. The lowest figure is called as permanent working capital because it is going to be there in the business always. Rightly so, nobody does business. Business people will expect something, some minimum level of operation, possibly to cover the break-even level of operations, or little more what they perceive. And so therefore, the working capital will be of two types. One is permanent working capital or core current asset. Anything extra is called seasonal. I can give you one more example. You take a river Ganges. The Ganges, Godavari, Kaveri and all these Krishna, all these rivers are always will have water, some water. So even in summer they will have some minimum level of water. That is called permanent working capital. But when you have rainy season, the level of water will go so much, and that is called as seasonal. Anything in excess of over and above the permanent capital, working capital is called as seasonal. In other words, how will you calculate the seasonal working capital? Total funds required minus permanent working capital. This is this side. So in my funds raising side, we try to understand short-term funds and long-term funds. In this side, we are trying to understand seasonal and permanent working capital. So that is the first step. What are the characteristics of a short-term funds? Short-term funds are, interest will be less, cost of borrowing will be less. For example, you deposit money in a fixed deposit for 6 months, they will pay you less interest. That means for the company, that cost will be less. Similarly, in business also, when you are borrowing short-term funds, they have less cost. Whereas long-term borrowings will have more cost. Whereas this side, permanent working capital is to be always funded by long-term borrowings. Seasonal working capital can be borrowed by short-term funds. So that linking of this is called as working capital policy. Now friends, there are 4 approaches to this financing of working capital, and every approach has some risk, some return, and it may be more risky and more returns, less risky, less returns. Risk and return will go together, that we all know. One approach is called conservative approach. Conservative means I am not willing to take risk. I am not willing to take risk. Suppose you pass CA or ICWA or MBA, some students may prefer to go to government jobs because they will be assured of good salary, less work and pension, everything is there. So they are happy with that. And some same MBA students, CA students would like to go for practice. That is also safe only. Then maybe going for business, investing money, risky. Why they are taking this? That is their appetite. So, in a conservative approach, the finance manager would play safe. What do you mean by playing safe? In a conservative approach, you will go for long-term funds. Find the funding of working capital through long-term borrowings. So that means you will have to pay large interest, but there is no risk. The maximum funds required you borrow now itself and keep it. So that may not be the right approach. In aggressive business, one has to start earning money. And second, that is one extreme situation, conservative approach. In that maximum funds required, estimated to be required is working capital, you are going to take it by long-term borrowings. Then the extreme, this side of the story is short-term fund. You are daily, every month requirement you are borrowing. Month to month basis. You just go borrow and repay, again take it like that. That's too much. So via media in between, that is what people will go, and that is called as hedging approach. Hedging approach says, okay, we will go permanent working capital be funded by long-term borrowings, whereas seasonal requirements shall be borrowed by short-term funds. And it is a trade-off approach also similar to that, little different in calculation, but it comes under via media. So this is called as working capital for policy friends. And I will take a problem. Let's go through that problem. I will read out the problem. So I have explained you what is financing of working capital. What are the characteristics of short-term borrowings and long-term borrowings? And what is permanent working capital? What is seasonal working capital? And what are the different approaches possible? Conservative approach, aggressive approach, via media approaches. That I am going to try and explain you through this problem. Hanuman Limited has forecast its total fund requirement for the coming years as follows. January, February, all that for 12 months they have given. In other words, the production is not even. So depending on various factors, they would have projected the production, and that production requires this much of funds only. You find the lowest is 30 lakhs, that's called permanent working, 20 lakhs, December 20 lakhs you need. Therefore 20 lakhs is called as permanent working capital. The difference is total funds minus 20 is called as seasonal. Agreed. And maximum funds required is 200 lakhs. That also is only in July, not otherwise. So this is the problem. And short-term funds are 4% cost and long-term are 10%. First step is you prepare a table. The table, first column is months, January to December. Second column, total funds required. Third column, permanent working capital. Total funds minus permanent working capital is seasonal. So first let us focus on these 3 columns, 4 columns only I am talking now. Take the total of that and divide it by 12. So as I told you, working capital is basically an average concept. Therefore you divide by 12. So in this we found first policy is a conservative policy. In the conservative policy, and the person is going to borrow the maximum funds, that is 200 lakhs, by taking long-term funds. 10% of 200 lakhs is 20 lakhs is the cost just you need for 1 month. But then there are people who don't want to take this. That means you realize no risk. So the first column is total funds required. In that minimum is 20 lakhs. We take it as permanent working capital. The difference is seasonal working capital. But in a conservative approach, 200 lakhs shall be borrowed from 10% long term. The cost is very high, 20 lakhs, but then risk is also very low. The second thing is I am borrowing month to month basis. That's conservative approach. High risk this is aggressive approach. I take risk. So in other words, month to month you are borrowing means 85.33 lakhs I am borrowing average funds by 4%. The third one is called hedging approach. In this hedging approach, what I am going to do is, alright, 20 lakhs is permanent working capital, you go for long-term funds. So 10% of 20 lakhs is 2 lakhs. The balance 65.33 seasonal average funds, you go for short-term funds. Need some safety. So that is 4%. So in a hedging approach, permanent working capital is funded out of long-term borrowings and seasonal average funds will be borrowed out of this. Now another new approach is called trade-off. It is also via media. What they do is little more safety than the hedging approach. Average funds you have to compute. First step, calculate average funds. What is average funds in this problem? The average funds is equal to minimum plus maximum by 2. Minimum is 20 lakhs, maximum is 200 lakhs. So 220 divided by 2 is equal to 110 lakhs. First step is calculate average funds, 110 lakhs. So 200 plus 20 by 2 is equal to 110 lakhs. So borrow it from long-term funds and keep it in the business. So 11 lakhs interest is there. Now you see, in January I need only 30 lakhs, whereas I am keeping 110. Then if you see, only in June I need 150 lakhs, whereas I have got 110 lakhs, 40 lakhs more. So I will find out which of the months I need more than 110 lakhs. Then you find average funds, I take average. That is what in the last column I put 16.66 lakhs. That I will go with the seasonal. So you can compare the spectrum. The highest interest cost is in conservative policy. And the next best will be, next highest will be trade-off, not best. Then hedging and then conservative. Similarly, risk starts falling. Low risk, the conservative approach, no risk or low risk, but the risk is going on increasing. So in other words, the risk is falling, cost is going up. That's the vice versa, inverse relationship they have. So that is called as financing of working capital. Alright, so that all the points have been explained, kindly go through that, and all the problems will carry on like this. So we have now deliberated what is the components of working capital and what is the salient features of working capital, how to estimate the full cost basis, how to estimate the cash cost basis, and what is financing of working capital. Thank you.